Well, in a couple of hours, investors are going to be poring over the latest inflation reading at the producer level. The producer price index is expected to have ticked up on a sequential and year-over-year basis for both the headline and the core CPI. Right now, we want to bring in Krishna Guha. He is the vice chairman of Evercore ISI. He's also the head of the global policy and central bank strategy team there. Krishna, looking at this, yesterday with the CPI numbers, it was 0.3% for core. It's the third month in a row we've seen that, but that was within the estimated, within the consensus range. That was what people were anticipating. What do you expect from PPI today?
Look, I think PPI will be consistent with the Fed's preferred core PCE measure, coming in, appreciably lighter than the core CPI print, but on the slightly higher or firmer end of the range over recent months. Is that going to be enough to veto another Fed cut in December? Very likely not, in my view. I think we're on track for that December cut. But as we look into 2025, for sure the Fed is slowing down, and with looming Trump policies coming in, the outlook for the number of cuts is much more uncertain than was the case just a short while ago.
Yeah, I have to say, I care a lot less about the CPI or the PPI than I did 2 weeks ago. I think all that matters now is what's going to happen. What's this new administration going to do? How does that change both the economy? How does that change the potential for inflation? How do you try and figure that out, Krishna?
Well, look, I think we've all got to be, to use a favorite Powell phrase, humble and nimble here. Humble because it's very hard to predict exactly what policies the administration is going to enact. In other words, what's the difference between the campaign rhetoric and the actual policy that will be rolled out? And then we're going to have to be nimble in updating as we learn along the way. But look, it seems pretty clear to us that the Trump policy mix across immigration, trade, fiscal, energy, and regulation is net reflationary. The Fed is likely to view it that way too, and that means being a little bit more cautious about rate cuts next year. Of course, also in part because, once again, the economy is performing a bit more strongly than people had expected. That's fundamentally good news. It is not threatening overheating, but it does continue to fuel that debate as to exactly where the neutral rate setting might be and how much more distance there is to travel before we get there. So, I would have seen maybe 4 or 5 cuts under a more disinflationary policy mix with Harris. I'm expecting for next year, I'm expecting maybe 3 cuts with Trump, but there's more uncertainty in both directions around that.
You're expecting fewer cuts because you think the economy will perform better, and so fewer cuts will be needed, or you're expecting fewer cuts because inflation will be hotter than expected, and so therefore fewer cuts will be allowed to be given?
Well, I think the Fed will be principally focused on the inflation piece here. So, a crackdown on immigration will produce a bit of wage friction in those sectors where there's a lot of reliance on immigrant labor. The trade conflict will push up inflation over the course of next year, though very importantly, that's mostly a price level shock. So it's the sort of thing that the Fed doesn't have to react to too strongly. Fiscal clearly would boost growth. We also expect animal spirits to be very strong, particularly among the small business community. And that's going to be boosting growth and weighing against what might otherwise be a drag on growth coming from trade policy uncertainty. So there are some policies that are pushing upwards on growth. There are some policies that are creating some inflationary impacts. So we do think the Fed policy is going to be a bit less dovish than would have been the case otherwise. But the magnitudes, I think, we need to be sober about. I still think that the inflation pressures are not going to be insane. The Fed is going to be able to cut rates further. They're just going to be more cautious, both about the speed with which they move, slowing down to once a quarter after December, and they're going to be a lot less sure and sensibly project less certainty as to how far they'll be able to continue cutting.
Okay. Krishna, thank you. Appreciate your time.
Anytime. Take care. Bye-bye.